Hi guys, good morning. How are you?
Hello, sir. Good morning.
Uh,
Good morning, sir.
how many of us are in 18? Okay, take it's 9. It's 9:15. So let's begin. So let others join in over time. Okay. So taking our discussion ahead. So we started with understanding basic concepts around risk management the last time. So today we'll complete this presentation. So a few more slides to go, and then we'll start something new. So we are familiar with the overall org structure, the concept of risk, various types of risks, etc. Also, we introduce ourselves to a few important policies which you'll popularly observe in most banks and financial institutions. Now, let's talk a bit about the ways in which firms handle the risk exposures. So, 4 or 5 popular ways to do that. Firstly, avoiding risk entirely. So, when I say avoiding risk entirely implies don't do anything. So, in case there is a certain business opportunity, you simply let it go. So, if you don't do anything about it, as long as you don't have those assets on your book, you are avoiding risk entirely. So, in certain cases, this can be a good way ahead. Of course, this can't be done all the time because if this happens, then no business will function. Because finally, whenever a business is involved, you have to take certain amount of risk. So that way, deciding on which risk you want to avoid and which risk you want to take, a firm can decide on its future course of action. So that's avoiding risk entirely. Then risk diversification. So when I say diversification, you have to mix up your portfolio in such a way that you're able to diversify away the risk as much as possible. So again, something which we study as a part of fund management as well. We always say that your portfolio has to be diversified or well diversified. So when I say I have a diversified position, what exactly do I mean? Anyone? So what is that one item which will help me explain diversification quickly? Also, and before we go there, has anything been discussed pertaining to general risk management for a portfolio? Now we'll talk specifics here, but something which might have been covered elsewhere, maybe some basic concepts on risk and returns, etc., which might have been covered. Okay. So when we say risk diversification, and we even do it for our own portfolios. So imagine that you're investing a certain amount of money every year into your own personal portfolio. You will want to diversify your investments, isn't it? Now, you won't put everything in equity, direct equity, or you may not directly put everything in bonds or mutual funds. It's always good to have a mix or a diversification across your investments because that way the overall risk of your portfolio comes down. And the way to understand this is through the correlation parameter. We'll talk a bit about correlation later on. But through correlation, we try to understand how two asset classes are behaving with respect to each other. And if we have a negative correlation, even better. That brings down the overall risk which we are carrying on our books. So firms will always want to diversify their businesses such that they are able to bring down the corresponding correlation, and that way they are able to bring down the overall portfolio risk. So at a later point in time, we'll talk a bit about how you calculate portfolio risk as well. So when we talk of capital charge or capital risk, that is something which we'll cover in detail at that time. Then a risk appetite. So that implies, so you can imagine something like a self-insurance. So risk appetite implies that a firm decides that this much is the amount of risk which we are fine with taking, and anything beyond this is outside our comfort zone. So something to relate this with the earlier discussion on risk tolerance or risk threshold, etc. So a similar concept, a firm will decide on a certain number, which will try to quantify through either your risk appetite calculations or through your limits framework. So that will decide how much amount of risk I can get on board. And even if I do have to breach that, then there has to be a valid rationale as to why I want to breach that particular limit. Next is risk transfer. So one example of risk transfer could be using something like a CDS, a credit default swap. So we'll talk a bit about CDS in our subsequent sessions when we discuss credit risk. But an effective way of transferring your risk onto someone else. So either enter into a CDS contract with someone, or maybe uh, enter into a contract with the insurance company. That is, if something goes wrong, then the insurance firm is, or maybe even a bank guarantee. So possibly you'll have a bank to stand in case you default on some commitments. So all of these can be examples of risk transfer onto someone. That is, you're moving risk from your books onto someone else's. Of course, there'll be a certain cost for that, but you're willing to take that cost because you're able to move your risk away. So that's risk transfer. And also using derivatives. So derivatives happens to be an important product which gets used whenever you're to talk of shifting of risk away from your portfolios. So maybe a couple of examples could be using FX forwards to protect against currency movements. So imagine that you are maybe a software exporter, and let's say you have a large customer in America. So that customer will pay you in US dollars because that is their local currency. So you'll be raising the invoice in USD and the receipt happens in that currency. But maybe the project is long term in nature. So let's say the project is like 1 year long, and you will be expecting cash flows at specific points in time in the future standing today. Now, the thing is, there can be volatility in FX markets. Uh, so whenever I'm talking from an Indian company's perspective, I am concerned about USD INR rates because finally, whichever currency I receive, it has to be converted into INR. And in our case, USD INR is the right pair because the inflow is coming in US dollars. So maybe the software company might want to hedge its currency position. So it may approach a bank saying that we have a certain cash flow which will be received at a certain point of time in the future. So let's enter into a forward contract so that when once we receive the US dollars from our client, we'll sell it to you and you pay us equivalent INR. And what rate that exchange happens will be frozen today. So that's what we call as the contract rate for the forward contract. So have forward contracts been covered as a part of your other subjects as well?
Yes, sir. It is covered in the derivative market, sir. Forward,
Okay,
future, options, swaps.
okay, and that
So
is
not
already
for
done.
IBF.
Okay, all right.
And
Um,
also the portfolio diversification is also covered. The risk and return on all the models like CAPM and Markov. Every model has been taught in the SAPM.
okay,
Yes,
all
sir.
right. So this is for the financial economics class, right?
Yes, sir. We in the
Okay,
financial economics have been taught all these things, sir, already.
okay, all right. So maybe so a few things I'll quickly recap for the benefit of our international business students as well. So risk diversification we'll anyway spend some time later, so don't worry about this right now. But generally giving an idea of a FX forward. So imagine that. So taking the same example. So let's say I am an exporter and I have a US based customer and it's a long term project. Let's say 1 year, and I have cash flow which will be received at the end of 1 year. Let's say one single shot cash flow, maybe some X dollars. Now, whenever and when I say exporter, let's write this as an Indian exporter. So for me, everything has to be denominated in INR because all of my financial statements come in INR, isn't it? Now, my US customer is going to pay me US dollars because that is their local currency. So we agree on a certain project fee which will be paid at the end of the project. But me as a software exporter, I will be concerned about the movements in USD INR rates. That is, any kind of volatility which I observe here is of concern to me because I may lose if the rate moves unfavorably. That is, uh, if it moves against, that is, if the dollar weakens, that can be something which I want to avoid. So what I could do is, in order to avoid or in order to hedge this concern, I can approach a local bank and I can tell them that let's enter into a FX forward contract. That is, this is a commitment which me and bank are entering into. That is, today we simply sign on a piece of paper and we say that, at time equal to 1 year, we will exchange our cash flows at a rate of 75, come what may. So it doesn't matter at the 1 year time point whether the rate is 74, 73, it's not important because we have agreed on 75 today. So our exchange happens at 75. Whatever X dollars are coming in will be converted at this rate and I get equivalent INR. So through this I'm trying to eliminate the uncertainty which is observed in the currency market. So that way I'm freezing on a rate today, something which I am comfortable with, and that way I'm trying to mitigate my risk. So this can be one of the ways to avoid risk through forward contracts against currency movements. So is the idea okay? So why I ask this? Because international business students are seeing this for the first time. So is this okay?
Yes, sir.
Yes, sir.
Okay. So here on also, I mean, in case there is a certain concept which is covered for one of the batch but not for the other class, please let me know so that we'll quickly discuss that as well. So maybe it can happen that something has already been discussed in international business but not for financial economics or vice versa. So whenever that is the case, we'll quickly try to discuss that so that maybe for others it will be like a quick revision or a recap, whereas for the second half of the class it will be something new. So whenever that is the case, please feel free to let me know, and we'll spend a couple of minutes like we did now. Then there can be put options to cover certain positions on stocks. Now, we will spend time understanding options as well. So our international business class who have not studied options up till now, don't worry. Request you to hold on to this point for a bit. We have modules whereby we'll talk of options. So at that time, we'll talk of call, put options, etc., how exactly they get used as well. So request you to hold on till then.
So,
Now, yes.
will you share this PPT with us?
Yes, yes, of course.
Okay.
So you need not note it down. I mean, of course, any points which you want, you guys can definitely note it down along the way. But PPTs you need not have to write down. I'll anyways email it across.
Thank you so much.
Now, a few key reports which you'll observe in banks and financial institutions. Now, mainly banks, I would say. And these are also what you call as MIS reports. And when I say MIS, it could be a combination. So it could be for your own internal management or it could be for the regulators. So a mix of both. But for most banks, you are going to observe these reports being calculated daily. Of course, you don't have to calculate these things manually because you have ready systems which are configured to calculate these reports on a day-to-day basis. So that way you have a batch process which runs, and the batch process will ensure that the reports are generated at the end of day every day, or using the end of day values to be precise. So first is a daily portfolio valuation report. So this is nothing but understanding how much your portfolio is worth today. So this is something which will happen at end of day every day. So there'll be a cutoff time which will be decided. So let's say 7 p.m. every day, all the market parameters will be fetched, and that will be used to value whatever positions are there on the portfolio so that we have a detailed portfolio valuation report available for consumption. So generally, these things start around 7:30 or 8 p.m. in the evening, so that the next day, when the risk analyst comes to office around 9 a.m., all of these reports are ready in the system. So this is what we call as portfolio valuation. Now, why do we require portfolio valuation, etc.? We'll cover in the due course, but this is one of the reports. Next is capital charge or capital adequacy. So maybe I can combine these two together. These are important reports from a regulatory capital perspective. Again, basic techniques to calculate capital charge will be discussed along the way. Even the CVA methodology we'll generally walk through as well subsequently. But all of these come from your Basel guidelines. So did you have any topic which covers the Basel guidelines, at least in brief?
Sir, in passing reference in the first semester, just it was just made in a passing reference, not intensive.
Okay, okay. So we'll spend some time understanding these things as well at a later point. But just for now, imagine that this is something which every bank has to calculate on a day-to-day basis, and this is a regulatory requirement. So for every bank in respective jurisdiction, so let's say in India, the Reserve Bank of India will have certain guidelines which are given for capital adequacy or for capital charge, as we call it. And that is something which every bank has to abide by. Now, if they are in contravention to that, then the RBI can immediately start a disciplinary action against them. So every bank will ensure that their regulatory capital models are working correctly, and ample amount of capital is set aside, which is in sync with the regulatory requirements. Because no one wants to be in contravention with regulations. It can be a problem for the bank going ahead. Then illiquidity charge adjustment. So this is something which we briefly spoke about when we discussed the policy on illiquidity, I think. Yeah, the policy on treatment of illiquidity. Because not every asset which I hold will be liquid enough. Especially this is true when I talk of maybe non-SLR securities. So one non-SLR is basically those securities which are non-government in nature. So is everyone familiar with the concept of SLR and non-SLR? So has this been covered as a part of your fixed income concepts?
No, sir, this has not been covered in fixed.
SLRs are statutory liquidity ratio.
Yes, so that's the ratio actually. But what securities are generally studied under SLR or classified? So something like maybe T-bills, T-bonds, etc.
Yes, sir. It has been covered in the commercial banking class, sir, in the last sem.
Okay, and this is for the financial economics class, right?
Yes, sir. Yes, sir.
Okay, okay. So for others, for international business, generally when you talk from a bank's portfolio perspective, especially the fixed income perspective, you have SLRs and non-SLRs. So SLRs are, it could be treasury securities, T-bills, T-bonds. Many a times you have state development loans, what we call as SDLs, etc. So all of these are what you classify as SLR portfolio for a bank. And generally for any Indian bank, this portfolio size is going to be large for two reasons. Firstly, a few of these securities are to be held for regulatory purposes. And second is from trading perspectives, because this is a very, very liquid segment. This is a liquid portion of the market. So market participants will find it very, very convenient to transact in these securities. Whereas a non-SLR ones, so this is anything which is non-government in nature. So it could either be corporate bonds, or it could be bonds from NBFCs, or maybe bank bonds, etc. Banks, financial institutions which issue bonds. You could also have CPs, CDs, etc. So all of these come under non-SLR. So from a liquidity perspective, broadly, there's not much of a problem for the SLR bit because this is liquid enough. This is fine. But some treatment might have to be done for the non-SLR side of things because not every bond which you hold as a part of this non-SLR gamut is liquid enough. So generally, good rated bonds are liquid. So maybe something like AAA. So probably if I take an example of maybe an HDFC bond, that could be very, very liquid versus compare that with a certain small cap firm which has issued a bond and which has maybe a rating of maybe double B or something. Then naturally the liquidity and the demand for a lower rated bond is less because banks by their very nature are risk averse. So they will generally stray away from non-investment grade debt. So since we have brought up the word non-investment grade, how do I decide which is investment grade and which is non-investment grade?
Sir,
Okay, credit rating, yes. But how do I decide the cutoff? Or is there a cutoff which is defined? Okay. Something you guys can check out. We'll anyways discuss this along the way subsequently, but generally you guys can check out and maybe let me know the next time. So a small homework, not really a homework as such, and you can get this thing online easily, but you can check it out later. Yeah. So a few securities which are not liquid enough, there is a illiquidity charge which gets calculated. This is also what we call as a capital provisioning which is done. Now, the capital provisioning will try to answer the question that if I have an illiquid security which I want to offload tomorrow, then what is the cost that I have to incur for that? Because there will be a liquidity impact, right? So there will be an estimation of this provisioning, which is generally done by the CFO team within the bank, and they will keep this as a part of the capital provisioning amount. So a report is calculated for this as well. So the bank knows how exactly it's looking at its illiquid positions. Then exposure monitoring. So again, exposure monitoring is something we'll be covering later on because I would like to link exposure monitoring with the limits module in banks. Because most of you who will be joining any banks or financial institutions in a few months, you will have to work on such enterprise risk systems which will have an exposure monitoring tool. So if you have an idea of how do you calculate an exposure and how you monitor that, that will make things easy. So we'll talk a bit about exposure monitoring at that point. But for now, you can imagine that this is like a manifestation of credit risk towards your counterparties. So whenever I'm holding a positive exposure against my counterparty, I stand to lose if my counterparty defaults tomorrow. So we'll further understand the behavior of us as to how an exposure is calculated for a transaction. So request you to hold on till then. I'll explain a couple of ways to calculate exposure as well subsequently. But you can imagine this is a manifestation of credit risk, and I'm trying to understand or I'm trying to estimate that what would be the worst case scenario for me if my counterparty is to default tomorrow or if it's defaulting overnight. Then a report on collateral position and exchange. Now, this will be again linked with your exposure monitoring. So whenever I say a collateral, this is generally a cash or a cash-like collateral. So when I say a cash-like collateral, what do I mean? And what could be the meaning of a cash-like? So one is cash. This is easy. It's directly a fund transfer which your back office will do amongst each other. But there's something which we call as cash-like type of assets as well. So what could be those?
So the ones which are very liquid, typically the bills or gold or
Correct. So not really gold as such, but yes, government securities. So that we assume as cash-like because firstly they are assumed to be default-free unless they are a government of Greece bonds. But otherwise, yes, I mean, government securities are assumed default free and they are cash like because you don't have to take much of a price hit if you have to offload those securities. Because as I mentioned, your SLR segment is very, very liquid. So liquidity is not much of a problem. So you can either have collateral which gets exchanged on a cash or cash like basis. But generally, for most of your trading book positions, it is cash collateral which is exchanged. So at a later point in time, we'll talk a bit about what we call as a CSA agreement or a credit support annex. So something which we'll talk from credit risk management perspective. So I'll explain you the methodology for CSA as well, something which banks do on a day-to-day basis in order to manage their collateral positions. But this is something which has to be provided every day. So your back office will provide these numbers which risk will consume, because finally collateral will be consumed when I calculate how much is my exposure to someone. So that's why collateral report is important. And internal ratings and associated risk weights. So any idea as to why this point is required? Why do I need to worry about internal ratings? Where do I use this exactly? Can you guess?
Sir, when you assess when you're trying to assess the loan eligibility of an applicant, the bank can use either internal ratings, otherwise an external agency like CIBIL or CRISIL or something.
Correct. Very good. Yes. So as you rightly said, correct. And whenever we have, whenever a bank has to decide on any kind of its lending operations, or whenever it has to decide whether it can lend to a certain borrower or not, it will require internal ratings because internal ratings will help them assess the riskiness for a certain borrower. So you have credit risk teams in banks which will be doing the internal ratings for every customer which comes on board. And for every rating, there is a certain risk weight which gets associated. So we'll talk a bit about internal and external credit ratings along the way as well. So I request you to hold on till then. But these are a few key reports which you'll observe, which are generated on a day-to-day basis. Of course, there can be a few more because that way the regulatory framework is becoming very steep when it comes to overall reporting side of things. So banks are trying to automate as many reports as possible because if you compare the number of reports pre-2008 versus now, it has grown exponentially and it continues to rise. So that way it's a challenge for the banks to keep up with that because finally if it's a regulatory report, then it has to be prepared correctly. Any wrong reporting will land the bank in trouble. So banks will try to automate these reports to a significant extent. So most of your ERS systems will support them. So maybe a Calypso or a Murex, something we'll talk about as a subsequent slide here. So these are like popular risk systems which you'll observe. So these can be readily configured. So you can either do that or maybe have an open source tool which can create these reports for you. So any questions on this slide or the previous slide? Okay. Now, role of technology in risk analytics. So technology is playing a very large role in risk management these days. So not just risk management, I would say in general banking business as well, because you see that most of the bank products and services are moving on to digital platforms. So that way their customer outreach increases, their business continuity gets maintained. Also at the same time, their customer experience can be enhanced as well. So maybe a simple example of usage of technology can be maybe like a chatbot. So imagine that you're doing some banking transaction, let's say at 11 p.m. at night, and you have a certain query. So if you go to bank's website, generally you will see a small pop-up comes on one of the ends of the screen, let's say the bottom right part of the screen. So a pop-up may come that may I help you. So that's like the automated chatbot which the bank has configured. So it will have those most common queries which you may have in mind. So let's say there is a certain basic question. So there will be a section saying that is this your question? So if you click on that, you have a ready response at that point in time. So accordingly, you can do your banking transaction. So the advantage for this is you don't have to wait till 9 a.m. the next day when the bank opens and you call up the bank and ask them that this is my requirement. So what do I do? So that way, technology helps improve your customer experience because it saves a lot of time and effort, and that way it helps in streamlining things. Also, retaining customers is important. So that is also something which technology supports. So all of these enhancements are there from the customer side or for the customers, I would say. So along with that, there are newer and innovative products which banks keep on offering. And whenever there are innovative products which come in, there will always be some additional risk which gets added onto the books. And whenever there is added risk, you need to have good quality risk models in order to uh, support the risk which these kind of products generate. And technology is one of the way in which you can implement these things well, because finally your risk model has to be implemented somewhere, right? So it could either be as a part of your broader ERS system, or it could be a part of your some standalone calculator. But again, you have to use some kind of a tech tool which will help you capture the risk which is inherent in a position, and that's why role of technology is improved. So always remember that your risk models have to move in lockstep with whatever financial innovation happens, because it should not happen that the innovation is at a very high degree, whereas the risk systems are still at a lower degree. If that is the case, it's a problem. Then your risk systems will not be able to understand or measure the risk which is actually inherent in a certain product. So that's why role of technology is enhancing, and it's enhancing rapidly. Now, also data analytics is something which has gained a lot of traction over the years. So I would say since around 2013 or 2014, data sciences has gained a lot of importance. And these days, data sciences is a very hot job. So that way, many companies are coming up with job offers around data sciences or data analytics in general. So a very interesting field, I would say. And a few things which data analysts generally do is things like trend analysis, time series analysis, etc. So, do you guys have these things which get covered? Maybe some any topics on machine learning or maybe data sciences? Is that covered as a part of your curriculum as well?
Yes, sir.
Okay, and this is for both the classes.
Yes, sir.
Okay, good. So that way, I mean, these kind of skills, I mean, I just mentioned a couple of them, but these are very handy skill sets. So things like time series. So, I mean, things like ARIMA or maybe S-ARIMA might have been covered as a part of your curriculum as well. So those are things which we use in the industry frequently as well. So maybe one of the things can be inventory management of a certain manufacturing company. So that's where time series analysis gets used so that I can estimate that what is the demand maybe for the next time period. Similarly, I may want to do some kind of basic trend analysis. So let's say I want to do some kind of sales forecasting. So I may want to understand my earlier trends so that they are captured and I can better manage my inventory base. So that can be another example. But in general, I mean, data sciences and many concepts which we'll be discussing as a part of this subject, they will go hand in hand because there is a considerable overlap on concepts as well. So that is something which I feel would benefit you from data sciences also, the concept which we cover here. Now, importance of systems knowledge is important. So when I talk of systems, these are mainly your larger enterprise systems, something like Calypso or a Murex. Now, of course, these Calypso or Murex are expensive systems. So these are also enterprise risk software, something which banks purchase. So this is like a complete treasury management tool, be it a Calypso or Murex. And this is something for which you will not have access now. But once you join a part of the bank, yes, you'll have access to each, and then you can explore these systems in detail. Next, we have SaaS. So again, software as a service. So we'll talk a bit about SaaS as well in one of our, I think I have a section on SaaS. Yeah, we'll talk a bit about SaaS in a bit. And we have Bloomberg and Reuters, which is primarily the data providers for most banks. So in your computer laboratory, do you have access to either Bloomberg or Reuters?
So not currently, I guess.
Okay, okay. But maybe once you guys, once everyone joins college in the offline mode. So do you guys are, I mean, any idea if your college has subscription to any of these?
So we have Reuters.
Okay, okay. So that's good. So maybe what you could do is explore a bit of Reuters once you join college back after this lockdown opens. And the idea is why I'm saying that you should explore it because once you join a certain bank, you'll be asked to use these terminals directly. Now, when I did my MBA, my institute didn't have this facility. So honestly, I saw Bloomberg for the first time when I joined Deloitte. So it took me close to a week to get up to speed. What is Bloomberg and why do we require Bloomberg? I mean, it was. I mean, since I never had exposure to that, I never had a chance to learn that. But since you guys have access to Reuters, try to make the most of it. Try to explore that platform. So at least have familiarity with the way in which Reuters functions. So once you're familiar with one, having familiarity with the other is not difficult. So that way, it will you'll already be ready to use these market systems once you join your respective firms, so that you don't have to waste time understanding those systems there. So, also maybe what you could suggest, what I would suggest is you can ask your college to get in touch with Reuters and ask them to have a simple maybe training seminar or something. So Reuters and Bloomberg do this for academic purposes. So that way they do free trainings for education institutes. So maybe it could be like an hour-long training. So I would suggest that maybe talk to your professors and ask them to arrange this thing with Reuters. And since you have already purchased a terminal, Reuters will be very forthcoming to support on any free trainings as well. So you could try that. Then there's a large potential for resources who have a knowledge of the following areas. Uh, so, uh, so I'm sure Python or R might be covered as a part of your course since you're studying data analysis. Uh, so,
Yes.
okay. So which of these do you guys generally use of the scripting tools?
So Python and sometimes R.
Okay, okay. Good. So that way, I mean, both are very, very handy tools. So I would say Python is slightly more general purpose. You can apply it for various scenarios and for various industries. R, I feel, is more geared towards econometrics or maybe some kind of economic analysis. But either of them, I mean, both of them are equally good. Maybe a few libraries here and there could be an advantage over the other, but it's good. I mean, you're exploring both of these things, which is good. And I would say that uh, keep your hands-on skills up as well for these tools because hands-on skills are something which are very, very important. So even on client projects, I frequently use Python. Now, I personally have never worked on R because I never had to use R, but I've used Python for close to 7 years now. I would say more than seven, I think around 9 years now. And it's a very, very handy and a powerful tool and something which I use for my training courses as well as for my client projects. And again, the biggest advantage is all of these are open source, right? And Python and R. You don't have to pay anything to use them. So the clients also love them because they don't have to pay any licensing costs. They just pay me a project fee and that is that. So I would say that continue with your hands-on skill sets. So how much amount of hands-on gets covered as a part of your courses? So are you developing models using Python or R, or is it just the basic stuff which is covered, something like looping, condition statements, etc.?
Sir, actually, we learn models only, basically.
Okay.
time series model,
Okay. So
logistic regression and all.
okay. So you guys have developed it along the way, or it's more of theory which is covered and hands-on is given as maybe a home assignment for you guys.
So it was a side by side, like we were taught it side by side. We were doing practical also and theory also.
Okay.
But there
Okay.
was a business analytics course, and it was from the IMS itself. So
Okay.
their module was just put into the course as it is.
Okay, okay.
Yeah.
So what I would suggest is generally try some hands-on along the way as well, so that way you'll remain in touch with these things because these are immensely important these days. Now, just having theoretical skills may not be enough. Now, client demands are also increasing, so they say that you know the theoretical stuff, but can you convert what you're telling us into something which our system will understand? So that's where I mean Python or R will come handy. Now, of course, MATLAB is also a possibility, but the MATLAB is a paid software. So for that, you have to pay a licensing fee. So maybe MATLAB will offer a cheaper student license now, but later on, you may have to purchase an enterprise license for your respective companies. And generally, licensing cost is something which companies will try to avoid. So at that time, maybe open source is something which will come handy. Uh, any candidates who are comfortable on C++? So something which you have studied earlier. Anyone? Okay. Okay. Because C++ is a slightly difficult language to learn. It's not very straightforward. It takes a separate time and effort to learn C++. Now, anyone who is targeting a role around HFT or high frequency trading, anyone has this as a career objective?
Sir, I have.
Okay, okay. So for you and anyone else who wants to make a career in HFT, I would say that start learning C++ because for HFT you require an immense speed of computation and decision making. That is something which Python and R simply cannot provide, and they are just not good enough for HFT. So for high frequency trading, and C++ is the way to go because that will provide you the required speed for trading purposes or trading at a high frequency. Now again, HFT also gets split into multiple categories. You may have certain funds which transact maybe every 5 minutes. So if that is the case, maybe Python or R could come handy. But maybe a certain strategy would be transacting every few seconds. So if that is the case, then C++ is the only way ahead. So those of you who have inclination towards HFT, I would say that pick up something on C++ and generally start browsing through them. And I would say that start studying C++ for now because it is going to take good 6 to 8 months until you get some kind of comfort on C++. Now, it will be incorrect to say that you will master C++ in 6 months. It's simply not possible because it is so vast. You can't do that in 6 months, but at least you'll have a decent working knowledge. Java to some extent, yes, but I would say in financial services, it's mainly C++. If I had to choose between the two, I would go the C++ way. Also, do you have anything on databases? So SQL or maybe SQLite or possibly even Oracle, etc. So is anything covered on databases as well?
No, sir, nothing as yet.
Not yet.
Okay, okay. So if not, this is also something which you guys should explore. And honestly, it's easy because you guys already know Python, etc. So that way, SQL, SQLite is pretty easy. Now, this is mainly querying of your database because when you say you have database working knowledge, you're not expected to be like a database administrator because there are other people with that skill set to handle database administration. But if you're working in big data, then every time you cannot have a .csv file as a backend. Of course, I mean the flat files are immensely convenient. But as the quantum of your data rises, you'll have to work with databases because imagine that you're holding Nifty closings for the last 10 years. So at that time, you can imagine the size of your Excel file. So it will be huge. It will be immensely slow to use Excel. So at that time, if all of this data is available inside a database for consumption, you can simply draw how much data you require. You can use it in your analysis, and you have a certain decision on your hands. So that way, having a comfort on these tools will be handy. And these are not difficult, to be honest. It's more of writing your database queries. So something like select statement, delete statement, etc. So I would say that you can practice this along the way. It's pretty simple that way. So maybe pick any sample database and try it out. I think that is something which can be done. Yes, someone has raised hand. Yeah, Mir, please go ahead.
Sir, I had a query. Sir,
Yeah.
in day-to-day balance, when you're working in bank as risk analyst, sir, how important was the software side of things than, let's say, analytical or using your CFA knowledge? Like, is it more of a software thing, or should we focus on stats also?
So we'll come to that. So can I just complete the machine learning bit and we discuss this point? So it's a
Yes,
good
sir, sure.
question. Yeah.
Sure, sir.
So this was about SQL. Then is machine learning and all of this advanced analytics, something like artificial neural networks, etc. So now these things are also gaining traction. And since you guys have a course on that, I'm sure this will be covered as a part of your course. So Python has very good quality libraries which will support things on machine learning, neural networks, etc. And gradually they are being used in risk management increasingly. They are already being used for trading purposes, etc. But for risk management also, I mean, they are gradually making inroads. So since it's a part of a curriculum, good. So I would say that keep reading things because that way machine learning is also a very vast area. So although Python offers you simple ways to do complex things, but the theory which runs behind machine learning is pretty deep and complex. So I would say that spend some time understanding that as well. So now coming to the question which Mir just asked, a very, very valid question. So let's say you're working as a risk or a data analyst in a certain bank, data analyst or a data scientist, whichever we call it. So for such a role, it's I would say it's a combination of skills which is required. So first and foremost, your subject matter expertise, which is your core finance or core banking knowledge, whichever. I think this is first and foremost. Next comes comfort on math and statistics. So things around maybe calculus or maybe even linear algebra. Also, when I say calculus, mainly and your differential or integrative calculus. Also, probably basic concepts around ODEs and PDEs also. Then I would say something around statistics, especially probability distributions. Also measures of dispersion, central tendency, etc. And of course, tech tools. So to make it big inside data sciences, especially, or maybe in risk analytics, for good roles in risk analytics, I would say these are a few skills which one should target. Of course, now don't get overwhelmed by these skills at the moment because you don't have to master everything in one shot. It's simply not possible. But these are a few things which are frequently required on your respective jobs as well. So that way, if you're comfortable with these areas, it becomes easy to do various projects or various challenging and interesting tasks which may be assigned to you going ahead. So starting with the SME, so that is what we call the subject matter expertise. So this is the most important part because this is your core knowledge or core skills. Because whatever you study, it should never be tool dependent. So right now, I mean, you're using Python. Tomorrow, you may use something else. So even I tell my other candidates as well, those who come for our courses also, that your knowledge should be agnostic to the tool which you're using. So today, if someone tells you to do bootstrapping, you may use a Python library to do it quickly. But tomorrow, if someone says that Python is not accessible, we want you to do it in Excel VBA, then you should be comfortable with that as well. So that way, your knowledge has to be, and the concepts have to be clear so that you're able to use any tool. So I would say subject matter expertise. So this should be your focus going ahead. So getting as much clarity on the SME bits. Now this is like a gradual process. Overnight, you cannot become a subject matter expert. Now, when you ask me after spending close to 14 years in the industry, I don't consider myself as an expert. I know a few things, but I'm also learning new things almost every day because client demands, project expectations are changing very, very quickly. So that way, one has to be up to speed always. So SME thing, yes, that is first and foremost. Next comes your math portion. So this is important, especially if you're targeting roles around data sciences or maybe model development, model validations, etc. Now, in case you're targeting roles around corporate finance or maybe M&A or equity valuation, I would not say that these things are required. So maybe points 2 and 3 are not very relevant for CF, M&A, or iBanking type of roles. But for other type of analytical roles, yes, they are very, very relevant. So calculus could be things like and differential and integral calculus. So starting with things like limits, continuity, etc. Next, you have linear algebra. So matrices or maybe solving a set of linear equations, etc. So I think you may be having something on statistics, right, as a part of your core course, maybe statistics and quantitative techniques or something like that.
Yes, sir.
Okay, okay. So at that time, I think a few of these concepts might be covered. So so these are relevant. I mean, these things have relevant applications in finance as well. So especially if I take an example of maybe a linear algebra. So one example which comes to my mind is solving a set of equations. So in case I'm looking at portfolio optimization, I may have to use LPP. So is LPP covered as well, which I call as linear programming problems?
Yes.
Yes, sir, it was covered.
Yeah. So it has relevance in portfolio analytics as well. So in case you're looking at portfolio return maximization or loss minimization, so that's like an optimization problem, right? So one way to do that is solving a set of linear equations, because you may be given a set of conditions which you're trying to satisfy for a certain set of assets, and that will help you figure out your asset allocation. So I recollect we had learned LPP using the graph paper. So I think you guys must have used the tool directly. But back in 2009, 2010, I mean, Python was something which I did not even know the name at that time. And our professors, they taught us through using the graph paper. So we used to have that rule sheet on one side and a graph paper on the other. So we used to solve the equations on one side and then plot it on the graph paper. But fortunately, because of these advanced tools, that I think the graph paper has vanished. So I think you guys must also have used Python or R directly, because it's a more sophisticated way of doing things.
So we
Uh,
did it on Excel.
okay, yeah, I mean, that's absolutely good. So
So
any
some
tool.
of us did in graph also.
Okay, good. So the graph is still in vogue, is it? So that's good. Good to know. So that's learning the hard way, but I mean, that actually makes things clear because you actually do something by hand, so you remember it. Good. So LPP has applications around portfolio optimization, also things like matrix algebra. So matrices are something which are frequently used whenever you're trying to handle maybe things around, again, something pertaining to portfolio management, something which we call as a black and determine model for portfolio allocation. So that where matrix algebra gets used. So since we are talking of matrices, a quick concept. So if I have a M cross N matrix, and if I have a K cross M matrix where N is not equal to K, can I have a result for this?
No, sir.
Okay. So does anyone think that I can get a result for this?
Sir, if you switch it like K into M into M into N,
Uh, no. So in case switching is not possible, can I get a solution here?
no, no, sir.
Okay, correct. Good. So, I mean, just a quick test of your things on matrices. So here again, the order of the matrices is very, very important because n and k, if they are not equal, your matrix multiplication doesn't happen. So this is something which you can quickly try through the M mult, which is available inside your Excel. So try setting different orders and Excel will throw a hash value or maybe a hash num error. Uh, so that way, I mean, for matrix multiplication, these things are important. So again, I would say that you might have studied these things at a certain point in time. So generally try to brush them up. So that is something which will be useful. Then differential equations, yes, very, very relevant. So we will be talking a bit about differential equations along the way because we'll require it when we study Black-Scholes or even things like geometric Brownian motions, etc. So we'll spend some time understanding ODEs and PDEs. Also, we will spend some time understanding probability distributions because they are equally important, something which will be useful not just now but later on as well, especially when we talk from an options theory perspective. Probability distributions become very, very important. Also, things like measure of dispersion, central tendency, so standard deviation, mean, median modes, etc. All of these things are important. So we'll do a quick recap anyway along the way. So I would say for those of you who come from, so anyone from a pure math background in this class. Okay. So what I would suggest is don't study these things from a pure math perspective, because if you do that, it will be a very intense exercise and you may get bored and you may put the book down and never refer to it again. So avoid doing that. Try to relate it from an application perspective so that it makes things interesting. So that's what we try to do along the course as well. So we will not do too much of math. We will do as much of math which is required, but we try and relate it with the financial concepts which we are trying to understand. So let's say we talk of a geometric Brownian motion or a Wiener process. We try and relate it with a Black-Scholes portfolio and then trying to understand why that concept is important. So even when you study these concepts going ahead, I would suggest that try to relate it with the underlying concepts which you have studied along the way. So that once you have a certain end goal or a certain application in mind, understanding these concepts become easy. If you study this from a pure math perspective, yes, I mean, some of you might have that inclination to do that. Yes, you can definitely pursue it, but it will be a time consuming activity. So you need to be patient in that. If that's possible, then fine. Otherwise, studying it from an application perspective is far easier. And tech tools, yes. So anything around these scripting tools, Python, MATLAB, R. So are you guys comfortable with VBA also? We will be using VBA as a part of our course. I will be using Python and VBA. So has VBA been covered in your other subjects? So Excel VBA macros.
No,
No,
sir.
sir.
Okay, okay. So what I would suggest is if you do get a chance, anyways, VBA is something which will require probably 2 to 3 weeks from now. So can I request you guys to generally browse through VBA? So maybe things like what are loops, what are conditional statements. Of course, those things are there in Python as well. But generally keeping an idea of the syntax for VBA. Don't try to memorize anything. It's not required. We'll do it along the way. But we'll use both Python and VBA as a few hands-on exercises along the course. So my request will be generally do some brush up. I think maybe a couple of hours, even if you spend on VBA, that should be good enough. So at least knowing that this is like a syntax which you can see. So how to use that we'll anyways discuss. But that would be my request so that once we start our hands-on activities, we don't have to spend time understanding VBA. Yeah, someone has raised the hand. Yeah, Mir, please go ahead.
Sir, in industry, what software is used, like Python, or do we use VBA?
So both actually, because many clients say that we want to stick to Excel, and we don't want scripting. So at that time, VBA could be a way ahead. Whereas some clients are more forthcoming, they say that fine, we are fine with any tool which you use as long as it gives us the required analysis. So I would say Python and VBA, if you have a combination of both, that is good enough. That will answer close to 95% of the problems which you will be asked to solve.
Okay, sir. Thank you.
And Excel, anyways, you guys are already masters in that, so that's not a problem. But VBA is something which we'll discuss along the way. So I would say for a good data scientist, these things are very, very important. Now, many universities sell degrees of data sciences. Now, that's my personal view. The thing is, no one can become a data scientist in 1.5 years or 2 years. It's simply impossible because for becoming a good data scientist, you need to know the industry, which is the subject matter expertise. And unless one works in the industry, one can never understand the problems for the industry. And if you don't know the problems for the industry, there is no way that we can actually use all of the advanced tools which are covered as a part of the curriculum to solve them. So I would say that it's a very gradual process. One can never become a data scientist in 2 years. It's a long journey, but that is something which is like a gradual progression which should happen so that as your core skills improve, you'll be able to understand what the industry requires. And once you know that, then using these tools makes sense. Otherwise, I mean, just having tools but no subject matter knowledge, then there's a gap, isn't it? Then we'll be software engineers and we know all the advanced tools, but we want someone to tell us what exactly to do with these tools. So I would say, even going ahead, whether you guys are targeting either roles around risk or data sciences, always try to maintain a fine balance between them. So both of these skills have to move in sync so that any core concept which you learn, you should be able to translate it into a line of code as well. So I'm not saying each and every concept, but majority of them. So that will make you a good data scientist or maybe a good risk analyst going ahead. So does this answer the question which one of you had on the skills required for risk or data?
Yes, sir. Thank you very much.
Okay. Now, a few key systems which you will popularly observe in the industry. So starting with, so I've written Calypso, but this can be Calypso or Murex. So these are treasury management tools. So they are very expensive as well because they give you so many functionalities that they cost a lot. So that way, banks will find it affordable to purchase these systems, because finally the core bank's business will be consuming these systems, and finally you need some way to monetize this expense, right? Because it will be like a one-shot expense which the bank has to do, and it will recover it over a period of time. So unless the bank's core business is big enough, affording these systems will be difficult. But for most scheduled commercial banks, at least in India, you'll observe that these are popular systems. Globally as well, these are popular tools which will be observed by, or which will be used by banking institutions. So a few features which Calypso or Murex provides is, firstly, it supports, yes, it's a entire treasury management tool. So when I say a treasury management system, you can see it is something which everyone in the front office, the middle office or risk, the back office, commercial and investment banking, retail banking, etc. Everyone will find some modules which are useful to them to a certain extent. So that way, you'll see that every team within the bank will have access to the enterprise risk system in some way or the other. Of course, those access permissions will be different for everyone, because that has to do from the overall operational risk management perspective. We'll talk a bit about it later on. But everyone in the bank will access this system. So you can imagine the size of this system and the complexity as well. So a few features which you'll observe here, you have product pricing. So calculating the daily valuation or daily MTMing of your products can be done through these systems. Then risk management, so calculating your risk metrics, so things like bond durations, option Greeks, etc. All of these things can be done and monitored. Then you can have a good collateral management tool as well, so that the collaterals which are posted by a counterparty, and for any places where you have pledged a collateral, that entire thing will be available at a click of a button. So that's the collateral management bit. Then limits monitoring. So one way to convert your risk appetite or risk tolerance into a numerical or a quantitative value. So that's what we call as limits monitoring. So we'll talk a bit about the limits module along the way. Then correct data mapping. So I think one example which I gave the last time, and your model is only as good as the. So did we talk a bit about data mapping the last time? So the way in which your data systems are linked to maybe a Calypso or a Murex. So so did we cover this in the previous class?
No, sir, we did not.
Okay, okay. So again, data mapping is something which is important both from your modeling perspective as well as model validations perspective. So the idea of data mapping is to ensure that whatever markers are inside Bloomberg or Reuters, they are mapped correctly to your enterprise systems. So imagine that I'm looking at maybe a 10-year government security. So I'm looking at this rate, and this rate is being sourced into my systems through either through a Reuters or a Bloomberg. So this could be my primary data provider. So so Bloomberg has what we call as tickers. So we have a BBG ticker, and for Reuters, if I recollect, it is Reuters RIX. So when I say a Bloomberg ticker or a Reuters RIX, that will be something which is a unique identifier for every parameter which you're looking at. So let's say I'm talking of 10-year GSEC, and let's say I have Bloomberg as a system. Then the Bloomberg may give the name to this ticker as maybe something like 10-year GSEC, something like this. So this is going to represent what is the 10-year rate standing today. That is, it may be something like maybe 4%, just a hypothetical number. So that way you'll get this new number every day. That is, at the end of market close, this market driven number will be different, because this will be a end of the close value. So it could be 4% today. Tomorrow it could be 4.2%, 4.3%, etc. And as a part of your enterprise risk tool, you're supposed to store all of these values. So at the end of every day, you're supposed to fetch all of the market parameters which are there into your system, so that they are consumed subsequently by your downstream calculators. Now tomorrow, let's say Bloomberg decides to switch this ticker. So currently it is called as 10-year GSEC. This is the ticker name on Bloomberg. Like, this is the unique identifier. Now tomorrow, let's say Bloomberg says that we want to make it 10-year I GSEC. So that way, this is a new ticker, isn't it? Because now Bloomberg doesn't source anything on 10-year GSEC anymore, but it sources it via 10-year I GSEC. So this is the revised ticker. So your data mapping has to be correct, because if your data mapping is incorrect, what will happen is if you continue to refer to 10-year GSEC only, then you will refer to some historical data, because this ticker is never going to get updated now. All of the updates will happen on 10-year IGSEC because Bloomberg has switched the ticker. So that way, having a proper data mapping is important so as to ensure that you're using relevant and fresh data and not the stale data at all. So this is something which we call as data mapping, important both from a modeling and validations perspective. Then you have risk reporting. So any kind of MIS and regulatory reports can be configured through these systems. So that way you can have any kind of drill downs which you require. Something, and all of these reports can be quickly exported to Excel or a CSV for further analysis as well. So these are a few key properties which enterprise risk tools provide, mainly Calypso or Murex. Next, you have SAS. Again, I would say it's a very handy system, but a very expensive one, because for SAS, and you have to purchase this system from the company SAS, and then you can use them. So a few things which SAS provides as well. You can do pricing, then you can do regulatory capital stuff like capital charge, CVA, etc. Then risk management, so maybe a value at risk, duration, etc. All of these measurements can be done. And SAS is generally configured modular, or there are different modules which you develop inside the SAS. And so maybe if your respective firms are using SAS, you'll get a chance to work on SAS as well. But otherwise, if it's a startup, then I don't think they'll be using SAS because it's an expensive software to purchase. So generally, well-established banks and financial institutions will find it useful to purchase SAS. But again, a very, very powerful tool, I would say. Bloomberg and Reuters, yes. So it can be, so mainly market data providers, yes, either of them. Then they have good quality pricers. So I would say from a pricing perspective, Bloomberg is far superior as compared to Reuters. Reuters models are not as good as Bloomberg. Then these also provide a trading avenue for banks. So if I take an example of Bloomberg, so Bloomberg generally comes in two licenses. One is only market data consumption license. And second is a license which will allow you to transact as well. So that way your front office will have the other license, whereby traders can get access to market data, as well as they can transact with other banks traders and hit trades on Bloomberg as well. So that way, it can be used as a trading platform also. Then it supports risk analytics. So Bloomberg has a value at risk calculator. And along with that, it also supports other simple risk analytics. And naturally, you have open source systems, something like a Python or R. So the biggest advantage is and these kind of tools help in quick or rapid prototyping of various model concepts which you want to do. That way, you can either use any platform you like. So either use IPython notebook or maybe any other platform. But that way, your libraries will function seamlessly anywhere. And I think the biggest advantage of open source is the quantum of libraries which are available. The libraries are just immense, and that will help you meet most of your requirements. So certain tasks could be available ready-made, and then you have to build on top of this. So that way, custom libraries come very, very useful. So that's an advantage. Then they support trading. So you have people who use these open source tools for trading purposes. It can be also used for various kind of data or risk analytics as well. So, so I think broadly, these are a few systems which you'll commonly observe in the industry. So any questions on the last two slides? Yeah, Mir, please go ahead.
Sir, can you explain anything about dark pools and use in India?
I can actually look up a bit. I personally haven't worked much on that, but I can generally explore and let you know.
Okay, sir, thank you. Yeah. So because I saw a clip on CNN that they were using something called ultra low latency high frequency trading, and it was routed to something called dark pools.
Okay. So generally, I mean, I'll just read up a bit. So yes, I mean, high frequency trading, yes, a few fund houses do use it, but I would say the quantum is slightly low. Now, banks generally stray away. So at least Indian banks, they don't engage in high frequency bits, but yes, for fund houses, it may be a possibility. So let me check it out and I can get back.
Thank you, sir.
So any questions on this presentation in general? something which we have discussed on Monday and today as well. We have discussed a few concepts along the way, but any other questions which anyone could be having in mind? Okay. Okay. So let's do this. So let's take a break for like 5 minutes, and maybe we regroup, and then we can start something new. Is that okay?
Okay, sir.
Yeah.
Yes, sir.
Okay. I guess can we resume? Is everyone back?
Yes, sir.
Okay. So now let's begin with some basic concepts today. So at least we'll have some background before we start exploring things around and random movement of assets or random behavior of assets, as we call it. So that is something which we'll cover in our next session. But this session will be more of and just revision of a few concepts so that we are comfortable to discuss those points. So a few things which will be useful going ahead. So is everyone familiar with mean, standard deviation, and variance?
Yes, yes, sir.
Okay. So maybe if I draw something like so, just doing a quick recap for everyone. So let's say I have a simple Gaussian, and let's say this, my expected value is 0. So this is what I call as my expected value of the variable. Let's say expected value of x. Now, when I say standard deviation, I say that I'm talking of any kind of variations which are away from this expected value. So I have this long-term expectations, and any kind of movements which happen on either sides is what we call as a standard deviation. So again, simple things which you can do via Excel as well. I mean, there's the STD function or STD function which is available. So now so maybe, can I request you to focus on the left side of this distribution? And can you think of a financial meaning for this left-hand distribution? Then we talk about right separately. But on the left-hand side, what could this
So
be?
less value than expected.
Okay. Okay. Anything more? So think from our subject, financial risk management perspective, and then would you like to elaborate?
But would it be the value at risk concept that applies on this side?
Correct, correct. Yes, very good. Uh, so when we talk from a risk management perspective, we are always worried about this left side of distribution. And always, whenever we study value at risk, we are talking of a left tail of the distribution. So you can imagine that standard deviation is nothing but a form of risk. So whenever we study portfolio risk and return, that risk is something which we try to quantify through the standard deviation or sigma. So as rightly said, whenever we talk from a risk management perspective, we are worried about portfolio losses, because anything on the left hand side, I can say this is like a negative return or maybe a loss for me. So from a risk analytics perspective, I am worried about losses. So when I study risk management, generally I focus on the left tail of the distribution. Now there is something which we do for the right side of the distribution as well. So could anyone guess what could that mean? And what is the financial meaning for the right side of the distribution? So these are my losses, the left hand side. And these are the places where I'm in the money. So maybe I'm holding a positive MTM, or you can say that unrealized profits. So any concept which you feel would relate to the right hand side of the distribution. So imagine I have a certain transaction with my counterparty. Let's say I have a derivative position which me and my counterparty have entered into. And for that, I would like to understand if there is any relevance of this right side of the distribution. So anything which strikes you, I mean, something which you feel would be relevant here. Okay. So on the right side, we generally study exposure. So as I mentioned, we'll be studying exposure monitoring later on, but exposure is something whereby I stand to lose if my counterparty defaults overnight. So there are ways to calculate exposure. So we do it for every position which is there on the trading book. So that's how, I mean, we know how much we have exposure to an XYZ counterparty. So whenever you have a positive MTM for you, you say that you are carrying a positive exposure. That is, if tomorrow your counterparty defaults, you stand to lose some money because of this transaction, because you'll be having a certain collateral. So maybe that collateral would make up for some portion of the loss, but not everything. But if I'm having a negative MTM, that's not an exposure for me. So whenever you have a positive MTM, you say that you are carrying a positive exposure. That is, if tomorrow your counterparty defaults, you stand to lose some money because of this transaction, because you'll be having a certain collateral. So maybe that collateral would make up for some portion of the loss, but not everything. But if I'm having a negative MTM, that's not an exposure for me. because if there is a negative MTM for a trade, the problem is for the counterparty. That is, tomorrow if I default, it's a problem for them, because they owe. I mean, I owe them. They don't owe me. So whenever, always remember, talk from an exposure management perspective, you need to have a positive MTM position, or you need to have a position whereby you are in the money. That is, you are expecting some kind of a payment from your counterparty. So that is what you call as exposures. So generally, risk is something which we study on the left side of the distribution, and exposures are something which we study on the right side of the distribution. Then variance is easy. I mean, just the square of standard deviation. Then the concept of returns. So I have mentioned concept of returns. I have not mentioned concept of prices. So what could be the significance behind writing concept of returns and not prices? Why do I study returns? Why do I have to worry about them?
So
So,
when you start, go ahead, Vidhi.
so I think because returns are more comparable in terms of the portfolio, because the prices may vary. But if you want to compare to assets, returns are more comparable in nature.
Correct, correct. Yes. Yeah, someone else also had a point.
Sir, it was this point only.
Okay, okay. So good, yes. So finally, I mean, whenever we study any assets or even from a portfolio perspective, we talk about returns. So even when you talk to investors, they don't talk about prices, right? So, and the price could be anything. They would finally demand a certain return on their investment. So that's the underlying rationale as well. We always worry about returns. So why prices are not very important? Because imagine that there is a certain asset which was purchased at 1 rupee, and let's say that asset has become 25 rupees now. Now 25 rupees could appear a very small quantum. Someone may say, I mean, it's hardly any price level. But if you look at it from a returns perspective, it is 25 times your investments, or 25 times your basic funds which you are committed. So that's the concept of returns. So have you guys been introduced to the concept of beta?
Yes, sir.
Okay. So how do you calculate beta? So firstly, what is beta?
So beta is a market risk that that is, I mean, how is a particular share incorporating a market risk factor in its equity?
Okay. So if beta is equal to 0.5, how would I interpret this?
Sir, it could mean for every 1% change in stock market index, it would mean 0.5 percentage change in the
Correct.
underlying security.
Correct. Correct. So generally, whenever you have beta which is of a lower value, then you say that the stock is not very sensitive to the market. Now you could have a beta of 2 as well. So that way the stock is more sensitive to the market. And what's the beta for the broad market? Let's say for Nifty 50.
Is it one, sir?
One,
Absolutely. It is the benchmark. So beta is 1 for a benchmark. So for a broad market, beta is always 1. All right. So let me do this. Can I just switch to my whiteboard? I'll read the point from here and we'll discuss it there, because the space here may not be enough for the discussion of all of these points. So I can read the point here and we'll discuss it there. So let me just share my whiteboard as well. My paintbrush is open, is it? Yeah, I think it's open. Let me just try sharing that. Yeah. Okay, yeah, share my whiteboard. Okay, so you might have discussed beta earlier. So what's the formula or how do you calculate beta? So wait, I'll give you an example and then you give me the steps. So let's say I have time 1, 2, 3. Let's say I have 252 days of data. Then let's say, or maybe I have, let's say 500 days, whichever we like. Then maybe I have a certain company X. I have the closing prices. So let's say X1, X2, and so on up to X500. And let's say I have the market M. So I have M1, M2, and so on up till M500. Now, this much is the amount of information which is given to me. So let's just highlight this in yellow. So from Excel conventions, anything which is the input is in yellow. So now this much is given to me and I want to calculate beta for my stock X. Now X is my stock, M is my broad market, and T is my time step. So imagine I have end of the day prices, end of the day closing prices, which I have for the stock X as well as for my broader market. So how do I calculate beta?
Sir, it's the covariance of the market and the stock divided by the variance of the market.
Okay. So do I take price levels directly or do I need to do something else?
Sir, weighted prices.
Sir,
Okay. Any other views? Can I
So you need
directly
to
take X1, X2 and then can I just
no, no,
apply the
sir.
standard deviation?
So you need to take the returns.
Absolutely. Very good. Yes. So for both the places, for X and as well as M, it should be the returns which I take. So it should be the returns of the asset and returns of the market upon variance of the market, variance of returns of the market. So you can simply take the day over day return. Just so when I say return, you can imagine maybe for this step, it could be something like X2 minus X1 upon X1. Then maybe if this is X3, it could be something like X3 minus X2 upon X2 and so on. So that way, yes, you can calculate beta this way. So always remember and take returns and not the price levels. Any application of beta which you can recollect?
So while constructing portfolio.
Uh,
No.
oh, okay, portfolio construction, yes.
So in valuation back.
Oh, very good, yes. So portfolio construction. Okay, so actually the WAC was the point which I was looking at. Very good, thank you. Uh, so is everyone familiar with WAC as well? We can quickly go through otherwise. Weighted average cost of capital. Was this covered for both of our classes?
So for FE, it was covered.
Okay, and for
For
international.
IPF, we didn't calculate it, but we knew the concepts.
Okay, okay. So, so what's the important now? Actually, now before we just discuss WAC and why returns are important, because this is one of the applications where returns get used. So, without the concept of returns, we'll not be able to calculate the concept of beta as well. So that's just another concept of returns. Also, when we talk of returns, there can be intermediate cash flows which can happen. So many times we will have maybe interest or dividend payments which are received, something which we use when we calculate an inter period return. So something which we call as a holding period return as well. So that way returns get used there as well. So just a quick thing on WAC, something which will be useful maybe for your corporate finance part. So those of you who are looking at roles around CF, this is an important concept. So WAC is something which we call or which we relate to the concept of cost of capital. So most of the companies will be funding their capital through debt and equity investments. So that way they can either issue bonds or they could have share capital which they raised from the market. So let's say WD is the weight or the component weight for the debt portion of my portfolio. Let's say WE is the weight component for my equity portion. Now I have a KD, which is I call it the cost of debt, and I have a KE, which is the cost of equity. Now we'll quickly talk about KE as well later on. Now, if I have to calculate my WAC, how do I do it? What would be the formula which I apply? Anyone? And is there anything which I have missed when I have to calculate the WAC for this setup?
So can I try?
Yes, please.
So for WAC, it is combination of weights appropriated to the debt or equity. So in this case, it will be KE plus weight, combined weight. Sorry, the weight of equity divided by combined weight.
Correct. So that
And
weight is already given to us. Correct. So we are taking it as WE. So can I say it's KE into WE, which is my equity part?
yes, sir.
Okay. And for the debt portion, can I write it as KD into WD?
Yes, sir.
Anything else which I have to add?
The
sir,
tax.
isn't it post-tax cost of debt?
Absolutely. Very good. So it should be 1 minus T. So debt provides a tax shield. So that's why 1 minus T component is something which you require for the debt portion. So I deliberately dropped the taxation part. So just checking if you guys remember, but good. So let's say T is my corporate tax rate. So 1 minus T. So by combining these two, I have my weighted average cost of capital. And again, WAC is a very, very important number which gets used for various analysis. So maybe any example of usage of WAC which you might remember from your corporate finance part?
So we use it for the valuation of company in the DCF technique.
Correct. Very good. Yes. So was it something which was covered for the financial economics class as well?
So it
Uh,
was an optional paper called Strategic Finance and Investment Banking. That's where it was covered. So people who opted for it learned it.
okay. Okay.
Sir, if we
But
covered it,
others,
if we covered
okay,
it.
it's covered, right? Okay. Very good. So that way, yes, definitely for assessing your future cash flows, we require WACC numbers. So that way, I mean, WACC is an important concept. So good. And again, cost of funding is a very interesting area to study and to work in as well, because every company will try and optimize its cost of funding. Because whenever we know that there is a for every unit of fund which is raised, there is a certain opportunity cost which is associated. So every firm will try to reduce that opportunity cost, because that starts eating into your overall firm's profitability. And finally, your main target is enhancing your shareholder value, right? So you try to minimize WACC. So accordingly, the company will try to manage the debt and equity weights. So was the concept of risk of bankruptcy covered as well when they spoke of allocation between debt and equity in your earlier subject?
No, sir, not
No,
that.
sir, not the bankruptcy.
Okay.
We studied leverage.
Correct, correct. So yes, it's a related concept. So and someone may have a view that since we are having a tax shield, why not raise everything in debt? Why do we really have to bother about equity? Someone may say we can junk equity and we can just go in for debt funding. So yes, it may appear as a very, very attractive proposition because of the tax shield bits which are provided. But the thing is, as one of you rightly said, it gets related to the concept of financial leverage, because that way, whenever we have a fixed amount of debt which has been issued to the public, then the company has to service the debt at regular time intervals. And for servicing the debt, it should have ample amount of cash flows which are being generated from the business. So if the business runs into problems, naturally the company will not have access to that much amount of cash flows. So it may result in default of its commitments on debt. So whenever we are studying any capital structure for a company, if the weight of debt is very heavy, then we say that there is always a certain cost or a certain risk of bankruptcy which is associated with that company, because there is a big chance that if something goes wrong, then that company might default on their commitment. So even market, whenever they do comprehensive fundamental analysis, they will always study this portion so that they know what are the fixed commitments for the company and what are not. So that way, I mean, WACC becomes relevant there as well. So we have a cost of equity, KE part. So how do I calculate KE? Anything which you remember the way in which I calculate my cost of equity?
Sir, the CAPM formula.
Correct. So do you happen to remember CAPM as well?
Yes, sir. RF plus.
Sorry,
Sir,
R.
RF plus.
Okay.
RF plus beta into RF minus RM minus RF.
Correct. The market risk premium. Correct. So good. I mean, this is the cost of equity bits. So this is something which equity analysts popularly use. So especially when one is doing maybe an equity research report or a company valuation report, this is the kind of formula which gets used for discounting purposes. So KE gets used as well. And of course, for your larger company valuation, you will require the WACC number. So maybe things like FCFF or FCFE. There you end up using a weighted average cost of capital or maybe a cost of equity based on the requirements. Correct. So anything else specific to this? Yeah. Yeah. Someone has raised their hand. Yeah, Vibhor, please go ahead.
Sir, I have a doubt regarding so cost of equity. Can you explain the theoretical concept behind this? Like, I understand the formula, but what's
Correct.
the theoretical meaning?
Correct. So the idea behind cost of equity is to try and assess and what is the riskiness for a particular firm. Because whenever we are calculating WACC, what we are trying to understand is what is the average risk for a company. And whenever we are looking at a company, yes, we have a debt and an equity portion. So when we are talking from an equity portion perspective, we know that whenever we are starting from an asset management point of view, we have a risk-free asset and we have a certain asset which we consider as risky. So something which we study as a part of Markowitz's portfolio theory as well. So there we have a concept of efficient frontier, and we say that assets are allocated along the line of efficient frontier. So there we have a classification between RFR, which we call as the risk-free returns, and we have risky assets. Now, whenever we have a certain company, that naturally has a certain risk which it carries, isn't it? Because it's not a government enterprise. Because government enterprise, whenever you have a full backing of the government, then you can assume yourself to be risk-free. But anyone who is in the corporate sector, naturally, I mean, they are, let's say we're talking of a private sector company, then they are not a government entity. So they have a certain risk which gets associated with them. And we try to understand, or we try to relate them in addition. So basically, in addition to the risk-free rate, what is the additional risk, or what is the additional sensitivity which that particular equity has to the market? So that is something which we try to understand through the KE part. So here, if we see, we have the beta portion, here we have the RFR portion, which is nothing but the risk-free rate. Plus we have beta, which is nothing but the sensitivity of this stock to the broader market. And we have the market risk premium, which is nothing but the return on this stock, let's say, or maybe RM minus RF, which we call as the broad market return minus RF. So here we are basically trying to combine these two sections together, that is combining the RFR section and the risky section. And so that could be one of the ways of looking at the KE part, or the cost of equity part.
Understood, sir. Thanks.
Thank you. Let me just go through the next point. Okay. Also, concept of normal distributions. So normal distribution is something which everyone is familiar with, something like this. So a few things with normal distribution is, firstly, it is a symmetric distribution. That is, on both sides of this central line, you have a symmetry. Now, my diagrams at times may be poor, but please consider they are symmetric. So this is our normal distribution, or the Gaussian curve, as we call it. Now, there are a couple of related concepts, which we call as skewness and kurtosis. So have you heard of these terms before?
Yes, sir.
Okay, so when I say skewness, what would that mean?
So we can say how the graph, where the graph is tilted.
Okay, correct. Yeah. So maybe I could have something like this. So I basically stray away from this symmetric part. So it could be something like this, maybe longer tails, or maybe something like this as well. So these are still type of normal distributions, but they have a skewness associated with them. Correct. Then there is a kurtosis as well. So, so let me just erase one section of this screen. So when I say kurtosis, what could be the meaning?
So how
Sir, it's
peaked
about the
the
peak.
distribution is.
Okay, so maybe let's say this is my normal distribution, the usual one. So I can have one that could be like this. And maybe. So imagine the line in black, the full line is the normal distribution, and these two lines are representing kurtosis. So do you happen to recollect the names for these two? What could be the line in green called, and what could be the line in the red called?
So lepto
Sir,
and vertical.
Correct, correct. So this is leptocorrect, and this is bracket. Also, and would you like to relate kurtosis with anything that happens in the tails of the distribution? So would you like to comment on that? How kurtosis will change that? Anyone? So sorry, my diagrams are not
So the
very
tails become thinner.
correct. So so maybe talking from a thickness of tails perspective, would you like to elaborate something? Anyone?
So leptokurtic distribution has more points towards the mean and also more points away from the mean, like more
Okay,
deviate, more extreme points as well.
correct. So now, so you're right. So could you extend this to a risk management perspective?
So the leptokurtic having more extreme deviations might be more risky.
Correct. Good. So yes, I mean you can relate the height of the distribution with the tails of the distribution, because finally we know that in the area under the curve has to remain one. So that way, for unity to be maintained, this thickness of tails changes. So for a leptokurtic, yes, you expect that the tails of the distribution would be thicker. So whenever you have a thicker tails of distribution, that means, can I say that the probability of extreme events happening is higher as compared to a normal distribution? Would this be a correct statement?
Yes, sir, right.
Yeah. So that way, from a risk management perspective, whenever the probabilities of such extreme events rise, that means your portfolio could be exposed to extreme loss scenarios, and those loss scenarios could have a higher probability of occurrence. So whenever there are thick tails, you try and relate it with risk management in that way. So good. So you're familiar with skewness and
So
kurtosis. Yes.
this I we definitely discussed this here in the previous semesters, but then there was this unresolved query that in this particular distribution you see that a lot of concentration is around the mean.
Correct.
So then that is also one way of looking at it, that all the values will be closer to mean, which is closer to your expected values.
Mhm.
So, I mean, it was an unresolved
Okay.
discussion.
So yes, I mean, most of your values will be expected to be around the mean, because depending on because finally there will be certain probabilities which will be associated around the mean. So that way, I mean, majority of the things will be observed maybe somewhere close by. But there are times whereby you have to look at extreme events as well, especially from concepts like value at risk. So that is where you start focusing on the tails of the distribution. So value at risk and expected shortfall. We'll talk a bit about that when we talk about. But these kind of events can also happen. And from a risk management perspective, we are concerned about what happens more around the tails, both on the right and the left tail, because for right tail, we have exposures, whereas for left, we have value at risk. So these extreme events are something for which bank makes a certain provision. So your capital provisioning happens in sync with the events which are expected around the left tail. And that's why the significance of this events around the tails is more important. Otherwise, you know that you have a certain expected value for a certain asset. So generally, whenever we talk from a small time increment perspective, we expect that asset's expected value will not change that much. But it is the risky portion which we are concerned about more, which is the standard deviation part. And that's why you'll always find there is a increased focus when we talk of tail events rather than something which is close to the mean.
Got it, sir. Thank you.
Also, and what's the kurtosis for normal distribution?
3.
Very good. Yes. So 3 is the kurtosis for the normal distribution, which is the black colored line here. So there is a concept which you call as excess kurtosis as well. So when someone says that excess kurtosis is 2, that implies that it's a leptokurtic distribution, and the 5 minus 3, that's how you arrive at 2. That's what we call as a that's what we call as an excess kurtosis. So many times people won't say the kurtosis is 3 and then we have calculated excess, but they'll generally say this is the excess kurtosis. Correct. Okay. So there's also something which we call as a log normal distribution. So what different or how different is a log normal than this normal distribution which we have drawn? So imagine this is my normal distribution. So what could be the difference in this and a log normal one?
No negative inputs
So
in log distribution, sir.
Correct, correct. So log normal is something which will be flowed at 0. So this if I call as normal, this is the log normal. And can you think of the financial significance of log normal distributions? So why this is significant? Anyone? So you're
So
right.
can be used in asset pricing models where asset prices can't be negative.
Absolutely. Very good. So especially useful for asset price simulations. Let's say I'm modeling a equity, then I would want a log normal distribution, right? Because my equity prices cannot be negative. Or maybe if I'm looking at FX, then even FX rates cannot turn negative. So that way I would want to have a log normal property. So that way, whenever I use a log normal distribution as the underlying for generating those assets, I can say that I'll be safely generating positive values only. So yes, log normal distribution gets used in analysis as well, correct? For especially asset price modeling. Then any other distributions which you might have heard about earlier?
So just a question not related to this
Uh-huh.
topic right now.
Yeah.
Did anything change in the modeling practice when the WTI crude prices went negative in April 2020?
So yes, I mean some bit of modifications are done accordingly, but that way what we do is we have a certain framework. So we follow that framework for a business as usual scenario, and whenever there are such extreme events, we try to make smaller tweaks to that model. So when we talk black shoals as well, I'll explain you the kind of tweaks which we generally apply. So even in your example, yes, the market would apply a small amount of adjustment in order to account for that. But the thing is, you don't junk a model completely. So maybe for a certain time period, if the asset of the crude or the crude or asset price has gone negative, you don't say that the entire modeling which you used to do earlier is junk. That doesn't happen. So you take the same framework and you make a small adjustment and use that going ahead. And wherever required, market keeps on making such tweaks. So the idea is you have to avoid reinventing the wheel. So when you have a certain model ready, stick to that, and whenever market demands, make slight tweaks, but continue to use a similar framework.
All right, sir.
Yeah. Also, any other distributions which you might have heard about or maybe read earlier?
Poisson
Okay.
and Bernoulli.
Okay. Yeah, Poisson, Bernoulli, similar. Yes, correct. Anything else? We have normal, log normal already.
Exponential.
Okay. Okay. And so all of these are univariate. If you have more number of variables, anything which you might have studied.
For multivariate normal distribution is there as well.
Correct, correct. So you can either have something like a bivariate or maybe a trivariate or multivariate in general. Also, can I say that a binomial distribution as well? So binomial could also be one of the choices. So good, yes. So normal, log normal is something which we'll anyways use along the way as well. Then yes, interesting is Poisson. So so firstly, uh, is Poisson a continuous or a discrete distribution?
So discrete, sir.
Discrete.
Correct. So of course, now for benefit of everyone, we'll quickly run through continuous and discrete systems before we begin. But yes, I mean it's right. It's a discrete distribution. Now, can you think of an example whereby Poisson may be used? It can be non-finance example also.
Yes, sir. Like like something that is not like something that is rare to be happen, like something accident on a road or something like a person's coming on a shop. Like the chances of the probability is like low for that to be occurred, and it is a rare event, sir. But
Okay.
something like this.
Okay. So depending on whether I'm not sure if we can say if you have to think of from a rare event perspective, but
Yes,
these
sir,
you
we
can
are not in like rare event, but like it is
correct,
not like accidents are not like continuously occurring, sir. But it
correct.
can be occurred within a
Yes,
interval of time, like in an hour, in a minute.
exactly. So
Yes, sir.
can I say that you're looking at the frequency of occurrence of certain events?
Yes, sir, yeah, we are looking at the frequency of the occurrence.
Correct, correct. So yes, a right example. Now you can apply this for credit risk modeling as well. So especially when you're trying to model a risk of default, you may want to use Poisson distribution there because it's an efficient distribution, especially for credit risk analytics. Whenever you're modeling the different times at which a default can occur or a default event may occur. Now, what are credit events, etc., we'll discuss along the way. But yes, for credit risk, poison becomes a very, very important concept. And also, one of you had mentioned about bivariate distribution or maybe multivariate. So, can you think of a scenario whereby these distributions might be used? So, let's say I want a bivariate distribution. Where would this be useful? In which scenario? Because if we know bivariate, we can extend that concept to multivariate also. So any example whereby maybe bivariate could be a better way of explaining things. Okay. So
Sir, suppose you have data about two different set of variables and both are individually following a standard normal distribution, then the combined distribution would be a bivariate normal distribution.
correct,
But I don't know any empirical example of that.
correct. Very good. Yes, yes, absolutely. So you have given a textbook definition. Very nice. I mean, that is perfect. So yes, as he rightly said, that is the right way of looking at a bivariate. So in simpler terms, whenever we have more number of assets which you are looking at, so let's say I have a certain financial product.
So
We
we can also take example like there are two stocks and the way like that the rates are changing and the distribution they followed like two stocks. So they can be said as the bivariate, and for the multivariate like many stocks or two or three stocks with some bonds also there, then it can be called as the multivariate
correct,
distribution. The
absolutely.
yeah.
Yeah. So combining both the answers, yes, they're absolutely correct. So let's say I have a certain asset V which is dependent on two variables, X and Y. So imagine these are assets. So that way, my asset price is dependent upon two independent quantities because X and Y can be independent stocks. So let's say I have a structured product which whereby it's a combination of these two underlyings and which is going to impact my overall value. So this is where I may want to use a bivariate distribution because now my variable is dependent on multiple or here two underlyings. I can have a basket of assets as well. So that way I may want to have a multivariate as the underlying. So the idea is whenever you have more number of such underlines which are impacting your asset position, that is where you have to go in for such multivariate distribution. So at that time, a simple univariate distribution may not come handy. Now, especially for structured products, this is something which gets used. But if you have to work on vanilla varieties or vanilla products, generally univariate distributions are good enough. Then a binomial distribution, something which we'll discuss as well along the way, because before we get on to Black-Scholes, a quick recap of the things around binomial would be very, very handy. So we'll spend some time there. But when I say binomial distribution, firstly, it's a discrete distribution. So that way, there are just two states of the world which I'm looking at. I could either move in, let's say, in a up direction or a down direction. So just to give you an example pictorially. So for those of you who have not studied binomial, generally giving you an idea, we will spend time later on this, but this is how a typical binomial tree looks. So this is just a two-step tree. I can have n number of steps. So that way, let's say I start from step 0, I can go to 1 or 2. Now let's say I'm on step 1, I can either go to 3 or 4. If I'm on step 2, I either go to 4 or 5. So that's why binomial. I just have to worry about two states of the world, and that way I have a binomial distribution which gets generated. So these are a few distributions which we'll use during our discussions going ahead. So I thought a quick recap of these concepts would be useful. Okay, so distributions are done. Yeah, so we have time. It's 11:10. All right. So I also need 5 minutes for the attendance. So we'll stop. So we'll stop our discussion at this point, and I'll need to take the attendance. So we are at 11:10. So just 5 minutes more for the attendance. So the plan for the next week will be, and also I mean, are you guys free on Saturdays? And how are you guys placed on Saturday mornings? Uh, do do you have any other sessions?
So Saturday will be fine, but morning in Saturday is like slightly difficult.
Okay, okay. So possibly something around maybe 11:30, 12 should work.
Yeah, sir, it can work, sir.
Okay, and that
It
will be
can
okay
happen.
for both the
Yes, sir.
classes, is it? Okay. So I'll talk to Srikant sir as well. So in case both the classes are available, we can have a session on Saturdays also. So that way we can complete our portion before time. Because if a project commitment begins, then I may not be able because we may have to miss classes then, which I don't want to.
So,
So yes.
so IBF has a class scheduled on Saturday from 9:30 to 11:30.
Okay. So basically after 11:30 it's good, right? So maybe if we have a couple of hours.
Yes, sir.
Yeah. So let me check with Srikant sir if your institute is also okay with it, and we can do that. So that way we'll complete our portion early. So if so that I mean anything comes up later, we don't have to miss any sessions. So let's see. I mean, let me talk to them. All right, so before we depart for today, can I quickly take the attendance as well? So do you guys have a lot of sessions today after this?
Sir, just one more class, I guess, for FE.
Okay. Okay. So let's start with the financial economics class. Akash Singh.
Yes, sir, present.
Okay. Achal Jain. Ayush.
Present, sir.
Adyasha.
Present, sir.
Tejas Akwari. Ali is present. Anjali Garg. Anmol Sen. Arishmita Deka.
Present, sir.
Avni Mishra.
Present, sir.
Okay. Ayushi Rotagi. Sarvesh is present. Bhavya Dan. Cherry Chhabra.
So, I used
Cherry Chhabra, is she present? Diksha Chauhan.
Present, sir.
Dipansha Singh. Gaurav Kadam and Gaurav Datir.
Present, sir. Gaurav Kadam.
Okay. And Gaurav Datir. Okay. Himanshi Verma. Jaideep Saini.
Present, sir.
K. Ayushi. Krishnakant Shukla.
Sir, it's Riya Shukla. Actually, the name is wrong.
Oh, okay. So should I change Krishnakant Shukla to Riya Shukla then?
Yes, sir, please.
Okay, present. Kriti Marwan. Okay, Kriti Marwan. Okay, Mansi Singhal.
Present, sir.
Mansimuran Arora.
Present, sir.
Manvi Kukreja.
Yes, sir.
Mihir is present. Muskan Garg.
Present, sir.
Namrata Gaur.
Present, sir.
Neil Dhar. Nikhil Agarwal. Prasul Sharma. Prasul is present. Yeah.
Present.
Pratik Maheshwari. Rachit Tyagi. Rahul Ghosh.
Present, sir.
Rahul Giri. Rahul Goswami. Rajaditya Singh.
Present, sir.
Rashi Jain.
Present, sir.
Rishabh Kothari. Ruma Keshri. Sahaj Manocha. Samiksha Chopra.
Present, sir.
Sharanya Bhattacharji.
Present, sir.
Shubham Jain.
Present, sir.
Shubham Kumar.
Yes, sir. Present, sir.
Someshwar Verma.
Present, sir.
Stuti Mehrotra. Sanika Thakur.
Present, sir.
Vinay Pawar.
Present, sir.
Okay. All right. So we are done with the financial economics class. So in case you have any other session after
Sir, you
this.
missed my name, Ali Asgar.
No, Ali, I have marked you present already. Yeah.
Okay, thank you
So
so
now,
much.
so gradually, I'll remember along the way now. So that way I'll remember few names so as during the discussion. So those which I already remember, I'll directly mark present.
Sure, sir. Thank you so much.
Ayushi.
Ayushi Rohagi present. I just missed the attendance.
Okay, Ayushi Rotagi.
Yes, sir.
Okay, yeah. I'll mark it.
Thank
Yes.
you, sir.
All right. So financial economics is done. Yeah, please go ahead. Yeah.
Kalyani Todkar, sir, I'm present.
Kalyani Tolkar. I think the name hasn't come. So are you a part of international business?
Yes, sir.
No, I'm yet to take that attendance. Yeah.
Okay, sir.
So FE is done. So I mean, FE guys, if you have any other commitments after this, please feel free to go. I'll just complete the attendance for international business, and we'll conclude the part. And about the Saturday session, let me have a word with Shrikant, and he'll update you accordingly. Yeah. Ayush Sharma. Now this is the international business economics class. Ayush Sharma.
Present, sir.
Okay. Alisha Gupta.
Present, sir.
Vidhi is present. Anant Jain. Anish Dopeshwarkar. Anjali Sethi.
Present, sir.
Arshada Imam.
Present, sir.
Barkha Islami.
Present, sir.
Bhavya Patel. Saloni.
Present, sir.
Chaitra Tirodkar. Devam Pandey.
Present, sir.
Okay. Diksha Kalra. Gauraja Nevatia.
Present, sir.
Okay. Gayatri Narkede.
Present, sir.
Okay. Govind Mittal. Savan Hak.
Present, sir.
Okay. Himanshi Veermani. Indu. Ishita
Present,
Saxena.
sir.
Kanika Goyal. Karthik Mittal.
Present, sir.
Khasro L. Lakshya Singhal.
Present, sir.
Okay. Mahi Rajawat. Mansi Gupta. Mathangi Wari.
Present, sir.
Megha Parak. Nancy Alawat. Neha Jain.
Present, sir.
Pratishtha Pradhan.
Present, sir.
Rohan Bagai. Rohit Poddar. Sabida Malik. Shivangi Semwan. Simran Pahuja.
Present, sir.
Srishti Verma. Tanu Goyal. Tarang Kadyan. Kalyani Todkar is present here. Twinkle Karnawat. Vaishnavi Shrotriya. Vanishka Jain. Vibhor is present. Vidushi Rana.
Present, sir. And sir, Himanshi is also present.
Oh,
She's
okay.
written in the
Okay.
chat box.
I'll mark her then. Yes. And Yash Mehra.
Alright.
Okay. All right. Yeah. So we'll stop at this point today, and your Shrikant sir will let you know about the Saturday session. Otherwise, we'll anyways have our Monday and Wednesdays from next week onwards. And the time will be morning. So only this week we had the evening class on Monday, so that will not be there. It will be a morning class always.
Thank you, sir.
All right. So
I
thank you
just
so much.
wanted to ask you,
Yes.
which all reference books should we refer for this?
So
Would the
yeah.
traditional FRM books work for this? The four books are
To some extent, yes. So maybe let's do this. So probably once everyone is there in the next class, and I can give you a few references so that others also are there, and we can discuss it at that time. If it's okay.
Okay, sir, and just one more doubt, a bit off topic.
Mhm.
Sir, I'm placed at City right now. Just
Okay.
wanted to ask if you know the kind of work or the or the day-to-day activities and the skills which I'll need. I've been placed in AIM, Analytics and Information Management.
Okay. So they have a job description or something which they have, is it?
Yes, sir, it's
Oh,
there.
okay. So maybe could you send it across? Generally, after going through that, I'll have an idea.
Okay, sure. We connected over LinkedIn. So can I just share it with you
Yeah,
over there?
yes, yes. You can send it on LinkedIn also. No problem.
Okay, sure. Thank you so much, sir.
Yeah. Thank you, and have a nice day and a good.
Hello, sir.
Yeah, Tejas.
Yeah, sir. I think I missed my attendance, sir. It's Tejas from SV.
Okay. So you're a part of financial economics, is it?
Yes, sir.
Okay, okay. All right. So I have to mark a couple of you guys. So one is Tejas and other is Himanshi. Okay, okay. All right. Yeah. So
Yeah,
thank you
thank you,
so
sir.
much and have a good day ahead. And I'll see you in the next class.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you.